If you feel overwhelmed about the real estate market and really not sure where to start, well, you've come to the right place. I'm Austin Evans with Aspire Realty Group. What's happening, guys? Austin Evans here with Aspire Realty Group, and welcome to my channel. If you've watched any of my previous videos, welcome back and thank you for that. So today I want to talk about a question that a lot of potential buyers ask me, and it's something I go over in every initial buyer consultation I have with someone. And that is, if you're looking to buy a house, what exactly do you need a budget for? How much cash do you need to put aside? These are questions that any potential buyer needs to know before buying their next house. Let's step back and break down the different things that you as a potential buyer need to budget for. First thing is this: if you're looking to finance your home purchase, not pay cash, but looking to finance, you're gonna have to have a down payment. Now, your down payment is going to vary really based on the type of loan that you're going to get, whether that's a conventional loan, FHA loan, VA, or USDA rural development loan. So let's break down each one of those to kind of give you a rough ballpark of how much your down payment might be. If you're looking to use a conventional loan, which is generally the most common loan that we see, you're looking at about a minimum down payment of 5% on that house. Now, some banks do offer for first-time home buyers, you could put down a little less if you fall in that first-time home buyer category and still get that conventional loan. But for rough, easy math, look at the minimum of 5%. So if you're looking at a $200,000 home, you're gonna be looking at a $10,000 down payment that you need to have in cash set aside. If you're going FHA loan, if that's the loan your lender said you qualified for, the minimum down payment for that is 3.5%. Now, you're probably asking, Austin, how do I get that low? Because it's less than the conventional one you just told me about. Well, back up. Those loans do have certain income limits that you do have to fall under. And this is where working with a quality local mortgage lender in your area is really, really critical to be able to explain all the details of each of these loans and really direct you to which one is best for you in your situation. But for FHA, for general purposes, you're looking at a minimum down payment of 3.5% of the purchase price. Now, VA and USDA RD loans are kind of some unique birds, so to speak. If you qualify for a VA loan, that means you are either in the military, a veteran, or a family member of someone where you have access to their VA loan. The biggest benefit of the VA loan is 0% down payment. You don't have to put any cash down, which is great. There are some other funding fees built into the loan, but again, this is where working with your local mortgage lender, they can explain what those fees might look like. The USDA RD loan also is a 0% down payment situation. However, the biggest difference is this: the USDA RD loan only applies to homes that fall into think of a grid on a map that the USDA government lays out for you. So if you're looking at a potential home and maybe it's out in a rural area, go to USDA.gov and you can pull up their map and type in the address of the house you're looking for. If that house pops up in the zone that is qualified for a rural development loan, then it might be a great option for you if you're strapped for cash. But regardless, guys, you want to make sure you work with a local mortgage lender and a local real estate professional to make sure everyone works together to guide you towards the correct loan for you in your situation. Now, you heard me mention minimum down payment requirements here for all these loans. There are some people probably out there going, hey, Austin, what about the 20% down rule? Do I have to have 20% down payment in cash to purchase a home? The answer is no, you do not have to have it. That 20% rule really only applies to one thing: PMI, or private mortgage insurance. So what that means is this: if you do not out of the gate own at least 20% equity in the home you're about to purchase, then the bank is going to add on to your monthly payment what's called private mortgage insurance. Now, it's usually a small amount. It could be anywhere from $50 up to a couple $100 a month built into your mortgage payment. And it's gonna vary based on the size of the house, the price point of the house, and other factors. Now, here's the cool thing though, guys. Just because you don't have 20% equity in your home right out of the gate, doesn't mean you're gonna be stuck paying that PMI, private mortgage insurance, forever. Once you have 20% or more equity in your home, which the way prices and home values are appreciating, that could be accomplished in the next couple years, you can call your bank and get that taken off so that comes off of your monthly payment. So again, you don't have to have the 20% down. It is an option, but you definitely do not have to purchase your next home. So that's the down payment portion. Let's look at closing costs. So in today's housing and real estate market, it is become common practice for both the seller and the buyer to each pay for their own individual closing costs. So closing costs for a buyer, to give you a rough idea of how much you might be looking at, you're looking at maybe 2.5% to 3.5% of the purchase price, to give you a ballpark idea of how much your closing costs might be. So the big question is, what in the world are closing costs and what does that actually consist of? So your closing costs consist of things such as title fees, appraisal fees, your lender underwriting fees, and other prepaid or state fees. So I'm gonna kind of break down what each of those are, because I know some of those words may sound the same or may not make any sense. So title fees. So whenever you purchase a new home, you're going to also utilize a title agent, someone who's going to do all the background work on the house to make sure the house can legally move from seller's name to your name, and that no one down the road has claim to the house other than the person selling it. Along that, each title company has certain fees that they do charge, whether it's a flat fee or a percentage of the purchase price. There's certain things built into that. Also along those title fees, you're gonna have something called a title insurance policy. What that basically means is you're making sure it's an insurance policy that says when you purchase your new home, that there's not a long lost relative down the road who can come knocking on your door and say, I own that house. It is an insurance policy that says the title company did their job right, and that you have what's called quiet title and the house is legally yours. Now, your mortgage lender also has certain fees. So after talking with your mortgage lender and you get pre-qualified, your mortgage lender is going to take your application and send it to his underwriters. He has what are called underwriting fees. Think of these people as the behind the scenes people to make sure they're double checking that you make how much you're telling us you make, that you actually have a job, you have savings, and you're not just drug running money back and forth basically. They're doing all the groundwork to make sure you're not committing mortgage fraud. And with that, there is a fee that is attached to that, and that varies from lender to lender. So if you have questions about that, make sure you talk with your mortgage lender and they'll be able to explain that to you. Another thing that is wrapped into your closing costs that you'll deal with when you finance is an appraisal fee. So all an appraisal simply is when you purchase a home, the bank who is giving you the loan is going to send out an appraiser to tell us pretty much what is this house worth. They're gonna run a comparative analysis on the house, look at what is sold in the area, and just make sure that the bank is going, what they're gonna tell you they're gonna give, it's worth it. Because at the end of the day, the bank does have to look at either keeping your loan on their books or resell that loan to investors. And now if the appraisal comes in higher than what we're under contract for, that's great news. You now have equity right out of the gate on that house. If it comes in a little lower than what you're under contract for, then you may have to pause and look at maybe renegotiating the deal a little bit, because your mortgage lender is only going to loan you the amount of the appraised value of the home. So it may be another point to talk with your realtor and your mortgage lender about what happens with the appraisal if it comes in low. But with that, to give you a ballpark idea, appraisals can run roughly around $600 to $800, depend on the location and the size of the home as well. Third thing you need to budget for when buying a house is the inspection. Now, I recommend all my buyers get an inspection done on any home they purchase. That is one of the, what I would say, non-negotiables that I try to negotiate for my clients on any offer we write. Basically, you have the right as the buyer to hire an inspector to come out and check out the house to make sure there are no surprises, that you don't have leaky pipes somewhere, you don't have a flood in the crawl space, the roof is okay and not falling in. These are really, really important things that you want to hire a professional inspector to come out and do. Now, an inspection is a separate cost to you as a buyer, and it is optional, but again, I highly recommend you have this done. You could be looking at anywhere from $250 up to over $500 on the cost of an inspection. It really, again, depends on location and the inspector, but it is definitely something I recommend any potential buyers of mine to make sure they have saved up for. And finally, guys, make sure you have just money set aside in savings, because guys, I'll tell you, there's no such thing as a perfect house. Even a brand new construction home is going to have problems along the way. And if you don't have some emergency savings set aside, you could run into maybe getting some credit card debt, consumer debt that you really don't want to have on your budget and balance sheet. So I'm a firm believer in all of my clients not being what I call house poor, where they spend every penny they have in cash to purchase the home. If every penny you have would have to go to purchase your next house, I'm gonna wanna sit down and help connect you to some other experts who can help you budget to save just a little more. Because guys, you don't need it until you need it. And there will be future home repairs down the road with your new house. So I definitely wanna make sure you have set aside enough to cover the unforeseen. Regardless, guys, I hope this has been helpful to you. I hope that if you're looking to purchase a house, maybe this has given you a good insight as to how much money you might actually have to save before buying your next house. And if you have any other questions about the home buying process or about real estate in general, make sure you continue to follow the page, like, subscribe to the channel, comment down below with any questions at all. Feel free to give me a call or text. I'd love to help you as much as I can. And again, thank you so much, guys. I hope you all have a fantastic rest of your day.